tech's been on a bull run for a long time, and we know that it's an industry that experiences cycles. So at some point, you do experience cycles. But broadly speaking, I think tech tends to trail NASDAQ, tends to trail the market. And if you see the jobs numbers today, it's clear that the economy is in a very good spot. So it's really unlikely that, aside from the volatility that we see all the time because there's speculation of regulation or of memory shortages or whatever, it's very hard to imagine just tech is going to go off a cliff while the rest of the economy is doing really well.
What do you see in light of that as sort of the biggest risk to the tech story right now? Is it trade tensions and that potentially ratcheting up with China?
I think probably it's actually the regulatory issues. Historically, if you look at Silicon Valley, we have not been active participants in the dialogue in Washington. It's not been part of the story. But these days, with the pervasiveness of the social media that we use and the depth to which it impacts everyday lives, it's hard to imagine that we can't participate in that discourse anymore. And so issues are coming up, issues of privacy versus convenience, issues of free speech. And the leaders of particularly the larger social media platforms are beginning to deal with the reality that this is something that's going to happen in the future. Even the younger companies, think about like an Uber or an Airbnb or some of our portfolio companies like Bird, the e-scooter company, or self-driving car companies like Aurora, all of these are going to face some regulatory issues, and they're going to have a big impact on the future of them. Exactly what it is, it's hard to say, but there's no doubt that regulatory issues are going to impact these stocks.
Mike Santoli, bring us up to speed, because Facebook is now trading below those levels where Mark Zuckerberg was going to initially go before Congress and people were sweating about the stock. Twitter's not doing so hot. Snap, which has never done really that great, is doing about as bad as it ever has. Where are we? Because at the same time, you've got some other tech stocks, Apple, which is about to release iPhones, Amazon, doing relatively a lot better.
Yeah.
What does that bode for the rest of the year?
A lot of valuation premium coming out of the pure social media stocks, in part because of all these things we're talking about, the threat of regulation and just kind of the public mood, they have no incentive to put up great numbers right away. So what really inflated these stocks for a while, especially Facebook, was the sense of inevitability around how fast their growth was. And the machine and the network just kind of spun profits automatically, and now they're interrupting that process. I think that makes sense. It looks like a very modestly valued stock, kind of the way Alphabet did for a long time. And I do think that that's really just a matter of it no longer seems so automatic to how fast they're going to grow. Also in a context of a tech sector, large cap tech in particular, that got overcrowded, got a little overheated, and lost some valuation support. So I don't necessarily think that this is a major inflection point in terms of the market's appetite for tech, because what you see is the NASDAQ 100, it's up twice as much as the S&P this year, but down twice as much off its high, right, which is only 2.5%, 3%. So really, it's just kind of ran ahead, and now you're getting some of that bled out of it. At the same time, you're having this weird shuffle of the index. It's going to redefine what technology is for index benchmarking purposes.
Yeah, how messy is that process going to be later this month?
I don't think it's messy in terms of the mechanics of it at all. I think it's going to be a perception thing, because if you take the technology, S&P technology sector down from 26.5% to 20%, are people psychologically going to say, I own too much tech? Or is it going to be about redefining three different sectors, consumer discretionary, tech, and communications, as basically tech proxies, and make it seem like you need to own one? So it's going to be a little bit of a noisy rebalancing, but I don't think it's because of actual money in motion. It's because of their perception.
Before we let you both go, given the fact that the news of the day has been Tesla and sort of the focus on what's going on with Elon Musk right now, you sit on quite a number of boards. This whole situation, funding secured a month ago, and everything that's played out with the possibility of the company going private, then not, shed a lot of light on the board of that company as well. If you were in that room having conversations, how would you, I guess, sort of guide those board members to deal with a situation like this?
Well, broadly speaking, we don't recommend our CEOs get on podcasts and smoke weed. That's not kind of a core recommendation that we provide. But look, I mean, Tesla is a very special company. If you look at the kind of mission-driven nature of what they're doing, the fact that they've inspired an enormous automotive market to chase this dream of electric vehicles and automation and so forth, you can't deny the fact that Elon's doing some amazing things. Obviously, in the last 6 months, there's been a lot of stress on him because he's taking a company that was building, I don't know, less than 100,000 vehicles a year, compared to, say, a Fiat Chrysler that does 5 million vehicles a year, and they're ramping into a real company. So in a sense, Tesla is an adolescent, and adolescents sometimes do a little crazy things. So you have to be a little patient with it and see what happens. But look, the guy is an extraordinary guy, and we'll see how this all plays out. But he sure is doing something special.